Good morning, Mr. and Mrs. Swinson. It's really good to see you again. I know that you said you have a little bit less than a half an hour for this meeting, so I'm going to jump right into what I have prepared for you. This slide shows an overview of what we're going to be covering today. Now, financial planning is a complicated and fluid process. It relies heavily upon complete and accurate data that is revised over time as needed. And as you can see over here, I have your client file, and in there I keep the engagement letter, which you had signed previously. I have your personal financial inventory and risk tolerance assessment. I have a prepared investment policy statement that we're going to need to do a little bit more work on after we talk today, and applicable documents that we need to do this planning process. Now, there are also some things missing. For example, I don't have your tax returns, copies of your insurance policies, your mortgage documents, or a copy of your auto loan. So those are things that we're going to need to get into the file to make sure that we have everything we need to do this process thoroughly and accurately. After that, we're going to look at your current personal situation. It's something that we call the life cycle approach, and we'll cover your goals that you had listed. We have to look at assumptions about the economic environment because they really dictate a lot of what we're going to do. We look at your current financial position, a balance sheet, and an income statement. Then we're going to analyze your overall strengths and weaknesses. Then I have recommendations that I've made, and we prioritize those recommendations. Then we look at the projected impact of those recommendations, and in the end we kind of sit down, finish up, decide where we're going from here, and see what's next. This is the life cycle approach I had mentioned. In it, we look at where you are in the cycle of life. Now, one of the most important factors is your ages. Now, Carl, you're 32, married 29, you've been married 2 years. You have no children, but you desire to have 2 children soon. There's a possibility that you may have to care for Mary's parents after they retire. That's something we need to consider. Carl, you're the 25% owner of IBI with a salary of $40,000, and you expect it to grow at 5% annually. Mary, you're an accounting manager with GAL with a salary of $65,000, which you expect to grow at 4% annually. And this is a good thing. Both of you are expecting your salary growth to outpace inflation. We're going to see when we look at your financial statements that you have a net worth of $70,255, and you are in what we call the asset accumulation phase. That's you're young, you're buying things, you're planning for your future. It's a time in life characterized by low net worth and high debt. And one of the things we're going to focus on from this life cycle approach is that IBI is a major portion of your net worth, and that there are risks associated with having so much of your retirement tied to one company. Now here I've listed the goals that you indicated in your questionnaire. You'd like to buy a new truck. You want to do an insurance review covering life, health, and property. You want to do a review and with recommendations regarding investments. Look at retirement planning, talk about education funding for college, and do a review of your estate planning and documents and see what we need to do in that area. Now, a very important part of financial planning is the assumptions that we're operating under when we make our plans. These are a list of the assumptions that I have made in preparing my recommendations today. We're looking at an inflation rate that's going to average 3%. Education expenses are expected to increase 5% annually. The national GDP is expected to increase at 2.5% a year. The S&P 500 going up about 9% a year, with bond mutual funds going up about 6% a year. T-bills and money markets expected to continue to yield 1%. New mortgage rates are currently 5.25%, with closing costs at 3% of the loan. We can get an auto loan today at 5.8%, 5.87% with $1,000 down. The tax rate is 25% and the state rate is 5% on federal taxable income. The current cost of daycare is $250 per week, and current college costs are $20,000 per year. Now, if any of these assumptions were to vary wildly, our plans and projections can be significantly impacted. The economy right now is a little bit unstable, so we need to keep an eye on things, and I'm going to illustrate later when we talk specifically about your retirement fund planning exactly how much of an impact any variation in these assumptions can have. It can be quite drastic, as you will see. Now we get into a review of your current financial position. This first slide we're seeing here is a statement of income and expenses, and that's activity for a specific time period, and the time period is the year ending for 2011. And as you look down, you can see the salaries, cash outflows with debt payments, taxes, insurance payments, and your living expenses. And at the bottom, we come to a net discretionary cash flow of $4,713. This next slide is a graphical depiction of the financial statement we just looked at. And as you can see, your living expenses comprise 40.92% of all of your expenses. Now, with debt being at 25.3 and the various items there. On the right-hand side, you can see a benchmark, and this is what the average expenditures would be for someone in your situation. So as you can see, you guys are currently a little bit high in the living expense area, and that is something we will specifically address in my recommendations later. The next thing we're looking at is your balance sheet. Now, the balance sheet is a snapshot of a point in time. So as of 12/31/2011, this is your balance sheet situation. And on the bottom right, a number I'd referenced earlier is your net worth, which is all of your assets minus your liabilities. Now, an item of concern I had mentioned earlier is that in your invested assets, you can see that your business interest in IBI comprises the significant portion of your invested assets. And because it is such a significant portion, there are some risks associated with that, and that, as I had mentioned, is something we will address in the recommendations later. And again, here is a graphical depiction of the balance sheet we just looked at. You can see that your personal use assets are 66.41%, and as you compare that to the benchmark below, that is a little bit high. And more importantly, on the right side, when you look at your liabilities and net worth, your long-term liabilities are pushing 70%, whereas the benchmark would be 25%. However, as we discussed earlier, you are in the asset accumulation phase. You're young, so this is not atypical. It's very typical, in fact, for people at a young age where you're situated currently in life to have a lot of debt, and over time, as you pay down that debt and your salaries increase, you'll become in a situation where you'll reflect more what the benchmark is. The next thing we're going to look at are some ratios, kind of financial analysis using numbers. And the first one we see here is the emergency fund. Now, you currently have a 2.13 emergency fund ratio. And what that means is that when we look at your cash, readily available funds versus what you have in non-discretionary expenses, things you just cannot avoid spending, you have to spend them, that you have enough cash on hand to cover a little over 2 months' time. Now, the benchmark, as you can see on this table, is 3 to 6 months. So that is something that we definitely need to beef up. And when we think about the fact that Carl is self-employed, and there all of the risks that we're going to talk about associated with IBI, we may want to aim to get higher in that 3 to 6 month range. Then below that is your current ratio, and that's basically your liquid funds versus your current liabilities. And you're a little bit low there, but by addressing your emergency fund and savings that we're going to talk about later, will help fix that one too. On debt ratios, the benchmark for housing payments is that we like it to be below or equal to 28% of your gross pay. You guys are safely below that at 16%, so we don't have any worries there. And when we look about your housing payment in conjunction with other debt, we like the two in total to be less than or equal to 36% of your gross pay. Again, at 27.5%, you guys are very safely below that. Down at the bottom, we have some debt to assets and net worth to asset ratios. Again, we talked about the fact that since you're young, you're in that asset accumulation phase. Your debt is going to be high, and that's something we're not too worried about now. On this next page, we have ratios for financial security. And when you look at the top, your retirement rate, that is an issue of concern. We're not saving enough for retirement. You're currently at 1.1%, and the benchmark is 10 to 13%. So that's something we're going to have to beef up. And that goes hand in hand with the savings amount below, that we just have to get it beefed up. As you look at that table, you are currently, for your age, doing okay for the amount of savings that you've accumulated, and that's largely due to IBI. But again, not to beat a dead horse, but there are risks there, and we're going to talk about that later. Down below, the performance ratios. If you look at the various benchmarks and your calculated ratios in return on investment, return on assets, and return on net worth, you are currently doing pretty well. So we're comfortable with what we're seeing down there. This next sheet illustrates what we call the three-panel approach. And we break out our analysis into three main sections: risk management, your short-term financial goals and objectives, and your long-term financial goals and objectives. Now, risk management has to do with adequate insurance coverage. And you're going to see in the recommendations that that's our primary area of concern today, the main thing we need to address. When we look at life insurance, the benchmark is that you would like to have 12 to 16 times your gross pay. And currently, Carl has virtually nothing, and Mary, you are insured but way underinsured. Now, as far as health insurance goes, the health policy you have through GAL is excellent, so we don't have any concerns there. Now, with disability insurance, Mary, again through GAL, you've got a great policy, but Carl, you don't have anything. And again, this is a business risk associated with IBI. But the target is we like to have at least 60 to 70% of your gross earnings available as a disability payment. Now, your home insurance is pretty good. We're going to have a minor tweak there that we're going to recommend. And your auto insurance is good, but we've identified an area where we think we can save a couple of bucks there. Now, we already looked in the previous page the ratios about the short-term and long-term financial goals. We talked about the emergency ratio and the housing ratios and your investment ratios and saving ratios. So this is just another way to depict those ratios, another way for you to look at them and kind of get a visual picture of what's going on with your financial situation. Okay, at this point, after having done all of that review of your current financial situation, looking at where you are in the life cycle, we need to identify strengths and weaknesses. Now, as I see it, your major strength is your young age and the fact that you don't have kids yet, because it provides you a lot of flexibility in planning. You both have good health, you have stable employment, and by the way, congratulations, Mary, on your recent promotion. And Mary, through GAL, you have great provided benefits. You have that great health insurance, your disability insurance, you get a 401k match, you have a great pension, and the flexible spending account. Now, weaknesses, as we mentioned before, the major thing we need to address today is that you're underinsured in a few different areas, with life for Carl, with disability for Carl, and a couple other things that we're going to change. Another weakness is the very minimal savings and your low savings rate. Now, those are things that we have some recommendations for as well. And another thing is the IBI business risk. I've mentioned it several times already this morning, but so much of your retirement planning is contingent upon the continued good performance of IBI. And what if a competitor were to come in? What if the economy were to tank a little bit and things don't continue to go as well as you expected IBI? Without that buy-sell agreement in place, what happens if something were to happen to one of Carl's partners or to Carl? It could really throw a wrench into things and cause a lot of problems. So that's something that we need to discuss in the recommendations that I'm about to show you. Okay, here are the recommendations that I have for you today. As I said, insurance is the primary area of concern. Now, we need to get both of you up into that 12 to 16 times your gross pay for life insurance. So Carl, we suggest that you purchase life insurance policy number 4 with a $500,000 death benefit, a 20-year term, and a $420 premium. Mary, you should purchase life insurance policy 3 with a $200,000 death benefit, 20-year term, $160 premium, and take advantage of the maximum GAL group term policy, which is 5 times your salary. That's only a $100 premium. Great deal. Carl, you need to purchase disability insurance. We're going to go with policy number 3. It gives you 60% coverage until you're 65. It includes a cost of living increase, and it's a $900 premium. Again, if so much of the success of IBI and your retirement are tied together, that if you were to become disabled, it could really cause some problems. With your homeowners, we're going to recommend that you switch from an HO2 to an HO3. Basically, it's just more expansive coverage against additional perils, and perils being things that can happen to your house. You'll just be a little bit safer. We're going to tweak Carl's truck insurance to save a few dollars because it's an old beat-up truck and I don't think we need collision on it anymore. And you need to purchase a personal liability umbrella policy. And that's just for overall liability protection, and it protects you as well against legal expenses if you were to have some kind of liability experience. Now, in addition to the insurance recommendations on the previous slide, we have a number of other recommendations. One, as we discussed, we need to establish an emergency fund immediately. You need to have that self-insurance to be ready for whatever may come your way that's unexpected. And we need to pay down the credit card as soon as possible. Just maintaining that kind of debt at that 12% really isn't feasible. We need to refinance your first mortgage to take advantage of the new low rates at 5.25%. Although we're going to incur closing costs, your monthly payment will go down about $183 a month. So we're going to take a hit in the first year. However, in the out years, it's going to be strictly savings. Now, for retirement funds, Mary should contribute at least 3% of her income to her 401k plan to take full advantage of the GAL company match. And we also recommend that you switch the funds in her plan to the growth and income fund because it's more in line with your risk tolerance. Now, Carl, we'd like you to investigate establishing a 401k plan at IBI. But for the interim, you need to start contributing to some kind of retirement vehicle, and we recommend the Roth IRA. Now, I have a slide that I'll show you later that talks about how much money you will need in retirement based on the assumptions you've provided us. And I also, as I alluded to, will have a slide that will show how those numbers that you will need can be radically affected by some minor changes in the assumptions that we've made. Now, moving on, we need to reduce entertainment and vacation expenses and miscellaneous expenses. As we discussed, looking at benchmarks, you guys are just a little bit too high in those areas, and there's a lot of savings available there that can help fund these other things that we need to do. We recommend that we postpone purchasing the new truck for a year. We postpone starting the education savings. As we discussed, we have flexibility there. So we put that off for a little while and focus on some of these more important immediate needs. And as far as estate planning, we need to execute a will, a durable power of attorney for health care, an advanced medical directive, and look into getting a buy-sell agreement in place at IBI as soon as possible. Now, if we were to implement all of the recommendations that we've made, you would end up with an income statement for this upcoming year that would look like what I have up here on the screen. And I've put it side by side with your income statement from 2011 so you can see exactly where the changes come into play. Now, right away in savings under cash outflows, you can see that we've got a huge increase, going up from the 1,200 up to a little over 12,000. And that will get that emergency fund and savings rate ratios right where we need them to be. Now, we do that by increasing Mary's 401k deferral to take advantage of the full match, starting a Roth IRA for Carl at $5,000 and getting $5,000 funded into that emergency fund right away. Now, your debt payments, we recommend getting that credit card payment down immediately, and you had indicated you wanted to start making big payments there anyway, so that's why that number is up. And the mortgage number, as we discussed, is up a little due to the closing costs, but in out years will go down. Now, down in insurance payments, you can see that we've gone up about $1,700, and it has to do with getting you both up into that 12 to 16 times gross pay for life and getting Carl protected with disability and getting a PLUP policy in place. So we move on to the next page. Now, our living expenses, many are merely going up by the 3% inflation. The big changes in this living expense area are cutting entertainment and vacation and miscellaneous by 50%. As we discussed, the benchmarks indicate that you're way too high there. We believe that there's a lot of fat there that we can cut and use to fund the other recommendations that we've made. Then we have a one-time $500 fee to prepare the various documents that we need to prepare from a financial planning perspective. The will, the durable power of attorney for health care, the advanced medical directive, and a buy-sell agreement for IBI. We need to get all of those things into place. And then, as we discussed, for a complete file, I will need copies of all of those things once they've been done. Although we have recommended that you postpone the education savings for a little while, because as we said, with your young age, not having the children yet, you have a lot of flexibility, and there are more immediate needs that we need to address. We did analyze the situation based on the assumptions that we had made. $20,000 cost times 2 children, with tuition increasing at 5% a year and investment returns at 8% a year. We would come up with a lump sum needed of $393,000, and that's if you started saving right when the children were born. and which would come out to an annual savings need of a little over $9,800. Now, another thing to consider is when the time comes, you can always borrow funds, or the kids may get scholarships. So those are things that we'll have to address as we monitor your plan going forward. This is just a graphical depiction of that savings rate that we would need for the college tuition plan. Here is an analysis of your retirement goal. Now we kind of blended the two of you together and came up with an average retirement age and went with the longer life expectancy. But the annual income of $95,000 in today's dollars that you desire, the expectation that you will have $44,000 in Social Security, inflation of 3%, investment return of 8%, we come up with about $1.8 million that you would need. And the annual savings is $7,500 when compared to your current annual savings would mean you would need a little over $5,000 more. And if you think back to that revised income and expense statement that we just did, you can see that we've covered these amounts with the increase in the 401k savings and the Roth IRA. And again, here is just a graph depicting that retirement savings plan out over time. Okay, Carl and Mary, now think back to the beginning of our meeting when I started off by saying financial planning is a complicated and fluid process. We rely heavily upon complete and accurate data, and it's revised over time as needed. I had talked about providing an example of what can happen if some of the assumptions that we've made to come up with this plan today go awry and turn out to be inaccurate. And I'm going to use your retirement goal as an example. If I were to change your life expectancy from 85 to 88, which would be a good thing to live a little bit longer, and then to presume that you really wouldn't get $44,000 a year from Social Security, you'd get $38,000, and inflation would be a little bit higher than we thought at 3.5 rather than 3, and our investment return would be a little lower than we thought at 7 rather than 8. Now, granted, this is everything going in the wrong direction. Things could get better, but we're talking a little bit worst case scenario here now. Your lump sum needed would go from $1.8 million to over $2.8 million. And the amount you would need to save each year in addition to what you're already saving would go from $5,000 to close to $20,000. So as you can see, if our assumptions turn out to be incorrect, our plans can be way off. And that's why we need to monitor this plan and maintain open lines of communication and to update things as changes would warrant in the future. So we've got to work on that investment policy statement. We have to make sure I get copies of the missing documents, the tax returns, the insurance policies, the mortgage documents, and copies of any of those new things that may be executed, like the will or a buy-sell agreement. You guys have a lot to think over here. You can look at this, decide if you agree with these courses of action. If you do, we will implement this plan, and then going forward, as I said, we need to monitor it and keep on top of it because things can change. So it's a lot to present here. I know it can be overwhelming at times, but hopefully it makes sense and you agree with a lot of it. And do you guys have any questions for me?